Hey everybody, welcome back to the show. I know it's been a while, but welcome back to the Financial Wrap. I took some time off from the show to kind of figure out what was working and what wasn't. I found that I was getting a lot more engagement on the podcast side with just audio than I was from the YouTube side. I don't want to shut down the YouTube side completely, but for now, at least in the short term, it'll just be the audio going up to YouTube as well as the podcast platforms. So there won't be any more videos on YouTube, at least for right now, and that could definitely change in the future. But I want to focus on the audio and the podcast format for right now. So without further ado, welcome back. I really appreciate everyone that is listening to this episode. I kind of just want to recap where we were at the last time I recorded an episode in the market, and then kind of give my outlook for what's ahead, and kind of give some commentary on earnings this week because we had some big ones report yesterday, including Amazon, Block, and Apple, which I will be talking about in this episode. And then I kind of just want to talk a little bit more at the end of the episode about where I see the show going from here. So let's get into it. The last time I was recording episodes, we were near the bottom, if not just off the bottom from October. It was a scary time when the show was originally running last year. We were in the middle of that bear market. Inflation was still really, really high. We still had like 6 and 7 handles on the CPI at that point, which at this point is down to 3, and we could be in the 2s with the report coming later this month, but there was a lot happening. A lot of people were scared. One of the things I was talking about was just basically to look for great prices and to kind of keep buying and holding and just dollar cost averaging, because it is impossible to predict a market bottom. No one knows where that bottom's going to be. And if you keep waiting for the bottom, like a lot of people did after the previous October, they got caught and they didn't participate in this up rally. And yeah, we'll most likely have a pullback, but is it going to go back to those October lows? It is a very good chance it might not. So dollar cost averaging is the best strategy, in my opinion, for any investor, for the core of your portfolio. Even if you're a really serious investor and you're really into reading the reports and going over the income statements, and you like investing in individual companies, dollar cost averaging is probably still your best bet for your main position. And then if you want to trade a little bit on the side, that's fine, but you really can't beat dollar cost averaging. It's almost impossible. If you do, you're lucky, but you're not going to get lucky over the course of 20, 30 years. So I'll get off my soapbox on that, but it worked. If you dollar cost averaged through the entire bear market, you would be looking pretty good right now. And it's probably still to your advantage to keep doing that, even if there is a pullback in the near future. So I just wanted to talk about that. And if you are going after some individual companies, you can always be on the lookout for a really great price. I know we'll be talking about a company a little bit later that reported earnings that might be trading at a pretty attractive price right now, but we'll get into that. So I kind of want to just talk about my overall market outlook right now. The market has kind of been on a euphoric rally, not even kind of, it has definitely been on a euphoric rally since last October. The S&P 500 is up over 20% since those lows, so we're in a technical new bull market. Recession fears have kind of abated. Even the Federal Reserve is saying that a soft landing is more likely at this point. And you even have some of the big banks like JP Morgan, Goldman Sachs, Citibank all reducing their probabilities for a recession coming later in the year or possibly in 2024. That being said, the market is trading at ridiculous PE ratios, and it's kind of almost funny that we're back in this situation again, because before the bear market that started last year, we were all talking about how the stock market was really, really high from a valuation standpoint, and that there were only a few stocks, now being referred to as the Magnificent Seven, that were driving a lot of these returns. Now, I have some thoughts on the Magnificent Seven, excuse me. I don't want to get too distracted here from the overall market outlook, but I feel like people have this thought process that because much of the returns are being driven by a few companies that they somehow need to get balanced out or go back down. And that's just not true. If you look back over the course of the entire history of the stock market in the United States, around 98% of the returns have been driven by just a few companies that rotate in and out and become the most powerful of their time. And right now, we're seeing some of the best run, most profitable companies that have ever existed. The likes of Apple, Alphabet, Amazon, Microsoft, even Nvidia could be thrown in there. And I think you have to also think about, can we even name 10 or even 7 companies that are better managed and in a better position for the future than Apple, Microsoft, Amazon? Because I can't name 7 companies that are run better than those. I can't even name 5 companies that are run better than Apple. So to an extent, the valuation can be justified. That being said, if we go back and look at the entire market valuation, we're sitting even above the 10-year average, which is around 18 to 19 PE. We're sitting above that right now. So while PE doesn't have to contract as soon as it gets to a ridiculous valuation, you can have a high PE for an entire decade, and you would have been missing out on really great returns if you sold just because of a high P/E ratio. But it is something to be aware of, because there really isn't as great of an upside technically if you're looking at that valuation. So it's just something to be aware of. Again, you don't want to fight the trend. The trend is your friend. We're clearly in an uptrend right now. That all changed when we crossed over the 200-day moving average, as well as our trend line that we had for pretty much the whole show last year. And we went into an uptrend after that. And we've pretty much been there since. Also, the Federal Reserve is most likely going to pause hiking interest rates. There's a good chance that they might be done, especially if inflation continues to come down. And I think that that's just another tailwind for equities if interest rates finally start to stay flat and even come down near the middle or end of next year. You definitely don't want to fight the Fed, and the trend is your friend. And right now it's starting to look more favorable for the market. You have to remember, the market is looking 6 to 9 months into the future. It's not looking at right now. So even though the Fed hiked interest rates last month, the message that's being sent is still hawkish, but if you look at the numbers, there's a good chance that we've plateaued interest rates and that those will be coming down in the distant future, in the medium term. So I want to talk about some of the earnings now that happened yesterday. The first being Amazon, and I found this to be interesting because it was kind of maybe the most hated stock out of that Magnificent Seven that I was talking about. A lot of people had concerns about cloud growth and about Andy Jassy, honestly, as a whole, running the company now. He's been there for about 2 years. But what we saw yesterday from Amazon's earnings was that the cloud growth actually started to accelerate again. And it's looking like we might have made a trough as far as the Amazon Web Services growth goes. That's a big deal because Amazon Web Services is pretty much the profit engine for Amazon that drives them to be able to do everything else that they do. We've seen Amazon try and penetrate so many different industries, including entertainment and sports now. Last year, they started covering Thursday Night Football, obviously with Amazon Video is their streaming service, but it's important to recognize that the growth could be picking up in Amazon again, because I think the story for the last year was an earnings recession and growth slowing down. But if growth has already slowed down as much as it's going to, and it's picking back up again, I think at the time of recording this, Amazon's up about 11% on the day. That could be a big story moving forward, and it's just something to be aware of. So that was one that I was watching yesterday. Another interesting one before I go to Apple was Block, for 2 reasons. This company was already down, or this stock was already down about 70% from the highs from November of 2021. And the company reported earnings last night. It was another beat on the top and bottom line. I mean, they're growing at like 35% year over year. Their profit margin is growing. Their gross profit was growing. The way they calculate net income, it includes their Bitcoin income, which is negative right now because of the bear market that Bitcoin has been in. But if you exclude that, similar to how you would exclude Berkshire Hathaway's equity holdings from their gross profit to kind of see how the actual business is doing, Block's business is actually doing very well, and it's growing at about 30 to 40% year over year total. And there was great growth in Cash App and Square. And Block just has a lot of ecosystems that can be attractive maybe for potential investors. And another reason I wanted to talk about it is because it's one of the big holdings for Cathie Wood's ARK funds. And a lot of those companies have actually been surprising on earnings. You have Coinbase, Roku, Block all really beating earnings, Teladoc included. And I think it's kind of a testament to Cathie Wood sticking to her strategy despite what other investors were saying about her strategy and her funds. And she's been rewarded year to date. I think her RK fund's up like 55% year to date. And that was one of the most beaten down sectors of the entire market. So there might still be some opportunity in some segments of the market if you look closely enough. And that was the reason I wanted to talk about Block. It's an interesting business to me. So finally, we'll talk about the U.S. stock market's crown jewel, Apple. They reported earnings yesterday. It was a beat on the top and bottom lines, but it was the third consecutive quarter of declining revenue year over year. Much of that was brought on by declining iPhone sales, which was kind of the revenue driver for Apple the last couple decades. But one thing that Apple's been focusing a lot on now that they've kind of acquired this massive customer base is keeping them in the Apple ecosystem through Apple services. These are things like iCloud, Apple Music, Apple Fitness, the subscriptions that Apple has that could eventually be bundled into one giant Apple subscription. We'll have to see if they do that. I guess Apple Arcade could be included in that group as well. But services is growing at a pretty good rate. And I think that's what Apple's going to be depending on for revenue in the future. I think there definitely could be some other things that they obviously make money off of in the future. You have the financial space that they're going into, healthcare, and that could all tie into services as well. But they're kind of moving into these different sectors now that there's not really a lot of room for growth as far as iPhone sales go. They are trying to penetrate the Indian market, and maybe that could pick up iPhone sales again, but it's almost a case of the product being too good. I know personally I've had my iPhone for like 6 years, and it's just so good of a product now that you can keep it for multiple years. You don't really have the same amount of people buying a new iPhone every single year anymore. There also just really hasn't been that big feature, I guess, that people are looking for. Like Siri was a big feature, and then you had like the thumbprint and then the Face ID. The camera keeps getting better, but other than that, there's not a big wow factor coming out of the iPhone. But I still think that Apple is the best run company in the world. I think that they're one of the best run institutions in the world. And I definitely believe that they're going to be around for a long, long time. And I'm definitely interested to see what type of businesses they want to go into in the future. They also have a massive, massive cash pile right now, which is good for the stock. I don't know how good it is for the company. They've vowed to go cash neutral, which means there'll be a lot of increases to the annual dividend, and there will most likely be a lot more stock buybacks as well, although I wouldn't expect that right now at the current price that Apple is trading at. So that's just what I wanted to talk about regarding Apple's earnings. Again, interesting to note that they've had 3 consecutive quarters of declining year-over-year revenue. So now that I've kind of gotten all that out of the way, I kind of want to just talk real quickly at the end of the show before I wrap it up about where do I see this podcast going from here. Like I said, we're going to focus a lot on the audio right now. I want to just put out good audio to the podcast platforms because that's where a lot of the engagement was coming from. And then YouTube's kind of just going to be a work in progress. Right now, I'm still planning on uploading the audio to YouTube, and it'll probably just be a thumbnail. The thumbnail will probably just be like the cover for the whole episode. and then I'll figure out what to do with it from there. I definitely think it was helpful to have like the charts and the technical analysis that I was doing on the YouTube channel, but one, if most of my engagement is coming from the podcast platforms, they can't see the charts, so that's not really helpful for them. And I want to kind of enhance the podcast experience right now. And then I'll figure out how to correlate that to YouTube. But that's where I see the show going from here. I definitely don't see daily shows. This will be more of like a weekly thing from now on. And I think that that'll be able to facilitate a better product and maybe better engagement too, because people aren't going to be dedicated and listen to your show every day. So yeah, I'll wrap it up there. Again, really happy to be back, and I appreciate anyone that's listening to this podcast episode, and I will see everybody next week.